Hey everybody, hey traders, happy Wednesday. We just had the meeting released today, FOMC meeting minutes at 2 p.m. Saw a little bit of an uptick around that 205, 210 window. So here is the meeting's release at 2 p.m. By 2:15, you had a nice little surge to some fresh intraday highs. We have officially marked another high for the year. So we have, let's go to a higher time frame. This is high number 3 or 4 for the S&P so far. So we have all-time high number 1, 2, and just a whisker there, number 3, technically number 3, and today is number 4. So we're getting a little bit more momentum going through these highs. I'm still looking at a big liquidity level this week at 615. Certainly the trajectory seems to be on its way towards it. So 612 by 6, it's a 611 by 612 debit spread that I put out for my double up alerts. That should be looking pretty good as long as we stay the course, stay above 612 for the week. If we ultimately tag that 650 level, awesome. So nice little trade there. I did poke some fresh all-time highs today in the portfolio for the year, which is nice. I added in some hedges. I think we're due for some volatility movements, whether it's up or down. Vol expansion, we got some big bar counts. I've got a pretty exciting thing that I'm looking at working with on scans and dashboards that put together two of my, really two of my like go-to strategies in one watch list that I'm continuing to curate. So I'm going to put together like probably a 200 to 300 stock watch list. And I know that's not going to obviously incorporate everything, but they're highly liquid and active stocks, lots of volume. And I'm looking to scan some of the biggest things I've used over my entire career. So I got some cool things in the works that's been in the making. So that's exciting stuff. So here we are, a little bit of noise intraday. Here's what I'm looking at liquidity level wise, 615. This level has grown all morning, by the way. This started out around, I want to say when we started trading today, this level was sitting around 1200 net and has grown to now over 2000 net. So there's clearly some flows coming in. There is a liquidity hunt. There is a chase to those highs. This is forcing market makers, if they're selling that 615 call, it is forcing them to delta hedge and be buying calls in order to have that properly neutral. So anyway, I think that we have a chance to tag that 615 by today, tomorrow, as we're coming into monthly expirations. Let's take a look at top down and see where everything is out. Everything's at today. If you're in the chat, type in wire yes, say hi, say good day, good Wednesday, whatever. It's a short holiday week because of President's Day. Here we are Wednesday with FOMC minutes. It's pretty low impact news for the week. It's just flow. Tariff talk didn't really do anything to budge the market. Fed said higher for longer. They're not looking to really cut rates or anything. Minutes today didn't reflect anything different. So here's what the Fed is saying. I didn't see the news change at all. Probability is still remaining with the pause. Here's the probability going into the rest of the year. So right now the market is looking at around a slight probability higher that in July the Fed's going to be cutting rates. So it went from June to now July. If they don't cut in July, which is what this probability chart is showing, then it looks like the higher probability would be September. So if it's a pause through the summer, so they don't do anything in June, don't do anything in July, then September, right now that has a pretty decent differential. That's a 43% probability they would be cutting rates by 25 basis points, and a 27.7% chance they would do nothing. But once they cut, looks like we're going to pause and stay there for the rest of the year. So the market is essentially pricing in one cut until about the halfway point of next year. And then this doesn't really make a lot of sense with how this is going to go back and forth, because they're obviously not going to cut and then raise and then cut again. So most likely it's like they just set the trajectory, set the course, stay transparent. The market prices it in. A lot of these rate cuts have already been priced in. I'm surprised the market hasn't dropped more other than what it did in December, with about that 5 or 6% haircut that we saw in December with some of the holiday drama post Fed. On December 18th, the market dropped a ton, and we came all the way back up to retest and then fell again. So that's just what we're dealing with. This chart that I'm showing here, SPX, this doesn't mean I'm calling the top. I was just looking for the potential bull trap, right? If there's a bull trap and this market turns, okay, fine. If we break to the highs and then we turn, I wouldn't be surprised. I still think the percentage away and the bar count away is pretty high. I'd obviously like to go back historically and see how relevant it is, but the last time we had a pretty decent stretch away move, we started to see price gravitate back towards this dynamic support. So it doesn't mean that it has to hit the 200 moving average, which is my red line, but it does mean I'm looking for prices to start to, even if they're going higher, starting to basically roll over and start to go sideways. The last time we had this really good stretch away move here, at this point we were around 11% above the 200 moving average. And same thing here when this market started to drop, it was around 10.5% above the 200 moving average. We had our July to August drop where we just came shy of the 200 moving average. That was another, 11 to 11.5%. And here we are with this level, about 9, almost 10%. Current prices, we could get up a little bit higher. We're only about 7.4% away from the 200 moving average. So this begs the question. This was about 11%. This was about 10%, 11%. Could we push another 2 to 3% higher, create about an 11% distance here, and then see the market starts working its way back down towards the moving average? And I think that's very possible. Okay, so as I've said in most of my classes and services this year, cautiously bullish, trading a lot of income strategies. The market's it's paid pretty well this year, considering I'm not doing much. I do want to make an announcement. I did end up closing out some shares of Alibaba today. I bought shares at 85.55. I bought again at 99. I'm closing those shares out prior to earnings, which is tomorrow morning. So, and look, I understand that earnings could blow this thing through the water, and we could be staring at Alibaba tomorrow at 135 or 140, and I'll take the risk and I'll take the opportunity cost. But if we have this thing falling at all from a 60+% rally, I'm going to go ahead and take the profit here on a really good move. It's basically been a ballistic run that's very one-sided, and I just don't want to give the market a chance to make a substantial pullback. So I'm taking the profit. I was up around $9,000 on BABA. I'm taking the profit. I'm moving on. But I still have income trades, ratio spreads, credit spreads, debit spreads, a lot of income generating strategies that have been from this low and this low and this little breakout stacked in a little bit on some credit spreads and debit spreads. So I've got some extra income to kind of juice the returns overall. But from my buy positions and holding, I'm going to go ahead and take the profit on that. So from the 85.55 position, I close these out. A lot of them are closing out at like 126 to 126.10. So I'll just take 126 as a simple number. 126 minus 85.55, $40. I'm going to write that down. $40.45 a share. So Alibaba. So 40.55, and then another one at 99, which puts me up around about $27 per share. And they were both dollar cost average positions. So I'm taking the ownership off the table. I still have some exposure in Baidu. I'm gonna hold on to that one a little bit longer. Baidu's also had a pretty decent sell off. They had earnings which actually beat top and bottom. That was yesterday morning, and they had a beat on revenue and beat on earnings, but I guess they forgot to mention the word AI or the letters AI because the market didn't like it. So market's down on Baidu, just in case Alibaba would have a similar reaction. That's why I'm taking the profit. I do have a collar trade running, so I have the 100 by 70, and I even rolled up some of these collars to like 105 and 110 with a break even in the mid 80s. So basically, for the ownership side, I'm break even on Baidu. I still like the stock overall. This one, if we get a run to like 115, 116, I think that's a good target one. I'm still looking longer term. I'd say in the next 12 months or so. 12 months, if we can get up to like 150 or 160, that's where I'm going to look to take most of my profit on Baidu. FXI, big gap to the upside, still has room to run to the September highs. I would be looking for pullbacks on this one. K-Web, same thing, looking for pullbacks. I am out of most of these trades from the first revisit of once we had our September thrust and we came back up for these two pops, I closed out most of my profit there. I didn't reestablish a lot of positions. I just stuck with some of my core ones. So JD is still doing well at 39. This one might not get called away. We do have earnings on this one coming next week. So if it stays above 39, I get it called away. I make like $500 or $600 a share, or $500 or $600 per account that holds the shares of JD. I think I have like 1,500 shares total right now. So that's fine. I also was considering a roll, maybe go an extra week, taking the earnings, but just in case it doesn't perform well, I don't want to sit on this one with extra time. If I can just get it called away at 39, I'll let it get called away at 39. Schwab dividend, Schwab growth dividends actually looking pretty good. I kind of like this. I'm already in this one. So this is SCHD dividends. check the positions here. So you can see here on my Alibaba positions, I closed out. These are all zeroed out. So I had shares on all these and I closed them all out. So currently up around $11,000 year to date, closed out. Still got another $5,200 running in profit. So I'll just let those continue to work. I've got about 75 to 90% of the max profit lined up, and some of these are out into the middle of the year, but they are so far out of the money that I'm not even worried about them, and I'm just going to let them do their thing and let them expire. More than likely not holding those and managing them early. I'm just going to let them do their thing. I was talking about SCHD for dividend right here. Currently, so my cost basis is around 28.46. This one does pull about a 3.5% dividend. This could be an interesting move. If we're going, back up towards these highs again, I can get a couple dollars of appreciation, plus a 3.5% kicker, which isn't too bad. I might also end up doing some rolls on MO. I've got a lot of my covered calls in this one at 50, 52.50, and currently trading at 53.36. I like this stock. What I might end up doing is taking some of the profit, reestablishing positions with maybe a bit less exposed. I'm currently sitting on, I want to say like $80,000 of profit on MO. Yep, $88,000 in profit, and I don't necessarily need to tie up all that buying power. So having 1, 2, 3, 4, 5, 6, 7,000 shares. So 7,000 shares at $53. I mean, that's $371,000 in buying power that I've tied up in a dividend stock. Now, that's about 10% of my overall portfolio. Why did I take that trade? I looked at it this way. A company that has really strong fundamentals, not a ton of debt, a good dividend, and low volatility, and a non-correlation to the S&P. I looked at it as, would I rather put my money in a 4% dividend, like a treasury, or trade the bond market, that is potentially still in a bear market if it's the TINA, which is there's no alternative and everyone's in equities, or would I consider the kind of corporate dividend side, which would be I own the shares and I get about a 7.5% kicker, with the stock that's actually gone up and appreciated in price on top of having that kicker. So I mean, that allocation to me was ideally supposed to be like a dividend play where I'm happy on that return for $371,000 allocated. If I generated $371,000 and I generated 0.0755, that'd be my dividend return. I mean, I make $28,000 on just dividends. But the fact that the price went from, I bought the thing less than $40 and it's up above $50, that price appreciation on top of that was a nice little double whammy. Like, this was not my intention to look at, hey, I'm up $90,000 on MO. Lucky, right? Like, the fact that the stock cooperated is excellent, and consider myself lucky. Now, I did, strategically buy it at a good spot. We had a lot of support down here around $40. I was willing to ride this thing lower into the 30s if needed. But the fact that we've come up here towards this like $50+ handle as high as $58, I might end up letting a lot of those positions go, reestablishing new positions and holding again for dividends, and probably doing like a 5 to 10% allocation just on the dividends, but also putting on a collar trade, which would be I sell a call above, I buy a put below, and I probably go out for like 6 to 12 months on a stock like this where the premiums aren't that fantastic. But to have it protected, upside or downside, get it called away is fine. Have protection of the downside in case something happens that pushes the stock back down into the mid to low 40s. But I would still look to protect as much of that as I can. All right. So in a lot of these expirations are going to be in March. So $50 calls, $52 calls. If I want to roll them out any further, let me take a look at the expirations here. So I could go to April and I could go to June. So I still have some opportunities to roll. Trade wise right now, got about 30 days left in these trades. Would I consider rolling? Any of these positions? Let me take a look at individual accounts here. So I've got the 1,000. It's covered at $50. Would I consider rolling to April or June and trying to get a few more dollars out of this? I don't. I've got plenty of buying power. Still sitting on about 40+% cash in my accounts, so it wouldn't kill me to keep the trade open until the summer. I don't really want to have to go too much further than that, however. So let me look at a roll. If I roll this out to June, really? Okay, so I can roll it to June, grab another 50 cents. That's $500 on this account. Could I roll it up to 250? I get another dollar, so that's another $1,200 of profit, but I'm increasing my cost basis a little bit. If I rolled it up $5, I'm only paying $2 and change, but that one may not get covered. Plus, I'm paying a debit and increasing my cost basis. So I think what I might do is just kick it out in time, go out another 90 days, grab another 50 cents, and that is a pretty solid, like in the money call. And I'll grab another $500 profit on that by June. So go out April, May, June. It's another 3 months. Make an extra, $150 a month, and then when the net position is called away, it's probably closer to like 90, 90 plus $1,000. Not bad. So do I like the trade? Yeah, I like the trade. If I went out farther, September, let me see if I can work this a little bit. I might try to, if I can try to roll this for free. That's what I was wondering. So I can roll it up $2.50, but I'm going to pay 50 cents for that. So that's another $2,000 I can get as long as price stays above 52.50. I think I like the June one. That's okay. I think that's fair. That's reasonable. So I own the stock, 50 cents. See if I can get this one filled. Mid price is 50 cents. I'm doing a roll. I'd like to try to get it rolled out at 50 cents. I mean, what I am doing is I'm sacrificing the upside. If this stock were to run higher, right? If it runs higher to $57, $58, I mean, the question is, do I want to tie up the buying power and just get it called away? What may not be the worst case scenario is I just let the stock get called away in March, reestablish a new position, buy the shares, sell a put, sell a call, buy a put, create a collar trade, and just reestablish a position from scratch. Take the profit, get the buying power back. Then I'll be probably sitting on closer to 50 to 55% cash, have a lot more buying power to show, which is good. I think that's so. That being said, I might just talk myself into, instead of making an extra $500, take the profit, reestablish a core position, and get a pretty incredible amount of buying power back, closer to like for a cash account, closer to like $40,000 of buying power. And then my margin accounts, $25,000 of buying power, 20,000 of buying power. Not bad. No. Chinese stocks, I'm really picky on that, Ryan. So NIO and was it NKLA, Nikola, Neo, some of the Chinese EV plays, I'm not interested in those stocks. My play is, look, the Chinese version of Google, the Chinese version of Amazon, that's your Baba and Baidu, right? Price to earnings wise, they're relatively cheap on a valuation side. China as a whole, as an index, as a country, has been undervalued for the last couple of years, especially. That's why we're seeing a lot of the money flowing into Europe, China. Brazil's been doing really well. India's been doing really well. I mean, money has gone to like beat up countries and indexes. And I think that's just because the U.S. is sitting here near these high valuations and money's trying to go rotate elsewhere. It's not like money is leaving the U.S. It's just U.S. might underperform. The U.S. might carve out a 10% year, and that'd be great. That'd be exciting. But that's more along the lines of what's average as opposed to the 20% we've seen the last 2 years. So I think if you're looking for higher gains. I mean, obviously the higher gains are going to come with some volatility and higher risk. I think if you're investing in China, you might have 30 to 40% upside in China, but you might be dealing with 20, 30, 40% of volatility as well. And it's a big wild card. So I like to keep the exposure somewhat quiet. I don't really care about NIO, just because there's a reason this stock has performed so badly, so poorly. I mean, since basically 2022, right? 2021's high. Uh, how do you go from $66 down to $4 and look at this and say, like, there's still promise? It still looks encouraging. No, it doesn't. I don't want to touch this thing. I think this is dead money. That if you get lucky on it, great. You throw, $437 at it, buy 100 shares, and if this thing doubles or triples in price, awesome. That's about as much as I would consider doing. It would be a very small allocation if I even liked it, but I truthfully don't. I don't think it's that good. I think there's a reason the stock has gone down, 99%, and I don't intend to try to be somebody that's trying to call the bottom. It's 95% lower, not interested in calling the bottom. So this might just tread water forever. This could be a buyout. There could be all sorts of weird stuff happening here. So I'm just going to let it sit there and hopefully not go to zero, but I don't own anything on it. And I think it's fine to stay out. Okay. What else do we have here? So let's maybe look at, I'm still, I don't know. I'm still going to kick around this MO idea. I might still grab because look, if I get an extra, let's go back to June. If I keep, that can't be right. March to June. This is showing 97 cents. That can't be right. It was just showing 50 cents a second ago. If I roll this out to June and I get an extra $900 on this trade, like that to me is worth it. I know that I'm sacrificing upside if the price appreciates, but I don't know. Let's see what I can get. If I can roll this for $1, I would take it in a heartbeat. I have a feeling though with the bid price at 35, I'm probably not going to get too much higher than maybe, I don't know. We'll see. Let's try 90. Let's try 95 cents. See if I can get filled in this for a roll. So 95 is not filling. I'm going to go just 10-cent increments. So I'll go 90 cents. Yep. And now it's working back down. I mean, it's plus the last like 8 minutes of trading, 9 minutes of trading. We're probably just seeing it going way lower. So 80 cents, not filling. 70 cents, maybe get lucky. I was okay at 60 cents. Not filling at 60. All right, 50 cents final offer. If it doesn't fill, then I'll just cancel it and think about it tomorrow. 50 cents. Not filling at 50 cents. All right, I'm going to cancel that for right now. I'll come back and revisit that tomorrow. Mohammed, if SPY pulls back and the moving average around 8%, would you aggressively buy with options? Yep. So my services like waterfall income, double ups, and I mean, newsbreakers isn't really going to fall in line with that, but it would be just like I would be shouting from every platform that I have, I'm going to be buying S&P, on a pullback. So, like I said, here's where things get interesting. It's like, are we able to sustain a close above? Like right now, this is probably getting everybody excited. Headlines are going to read with some optimism, right? The pain trade right now, it's like as many smart macro economists out there are just calling for like something terrible to happen. The market is climbing a wall of worry and continues to do so. Now, like I said, I have a legitimate concern on the technical side that if we're 11 to 12% away from this moving average, that even a blow off move of maybe 3 to 4%, I am calling a bit of a retracement. And timing wise, like I don't know, right? Is March or April going to be a pullback? Last year April we had like a 5% pullback, right? So maybe it's April. But either way, I think that this moving average gets hit this year. So if I do, and I mentioned this, several weeks ago, I said, look, the best opportunity that I have right now is keep trading the way that I'm trading, keep generating the income that I'm generating, and stay out of the way, give myself this big net for margin for error, and keep producing little 0.25% to 0.5% winners, and keep plugging away and trading as frequently as I need to trade over like 30 to 60 to 90 day windows. But if this market were to drop, okay, and I don't know what's going to be the catalyst. I don't know how ugly it's going to get. Do we have like a nasty, day like this where it's just like a 3, 4, 5% day? Maybe. Like what was that day during FOMC on the 18th? From top to bottom, that was a 3.5% day. That was a huge sell-off in the market. That was like one of the bigger sell-offs the entire year for that matter. Point is, I don't know how it happens. But if it happens, I'm still liking a lot of strong support, an aggressive kind of buy the dip. The concern, of course, is that I load up and I'm wrong. So I mean, how much am I going to risk? I mean, it's going to be mostly options. I would say if I'm timing this, like taking any trades in this area with about a 30 to maybe 60 day window, I'd look to see can the market bounce back and recover. If I was interested 30 to 60 days, could I say that 30 to 60, even going out to the end of the year? If we're about the halfway point of the year, could I go out to the end of the year and say, look, I think by October, November, December, this market is going to be trying to get back to these all-time highs again, just by typical seasonality flows. So that's how much I would be willing to position for it. I can go out, 30 to 60 days for more of like the income pickup over that like smaller window, but also say by November expiration, by December expiration, is this market capable of revisiting the highs? And if it is, getting a time in here to position for, trades on the SPY, trades on the Qs, trades on the Dow, trades on the Russell, trades on a lot of things, trades on XSP, SP. I mean, like I probably will take some exposure, a little bit of everything. There's obviously going to be some cross pollination. If I trade SPY and SPX, I'm still trading the S&P 500. But one is cash settled with better tax benefits, European style options versus one potentially as assignment. I don't mind taking assignment of SPY or QQQ if I had to, but I probably won't have to, nor do I really want to. Um, but if I had to, I'm not that worried about it. Otherwise, a lot of options. So bull call spread, so there's no assignment risk, and probably a bull call spread that's either, I take like let's say a 0.5% risk. Okay, so I'll just say like a 0.5% risk. If I stack up, let's say, 5 trades over a period of time, I can have a little, 2.5 to 3% move there. I could stack up, on 0.5% here, whatever. So do a little exposure on SPY, XSP, SPX, RSP's equal weighted. I'm watching that one as well. And then a Nasdaq, NDX, QQQ, QQE for equal weighted. Dow, if we pull back enough, I'd like the Dow trade as well. I think that's a good one. Russell, I'm probably just going to focus on IWX and IWY as opposed to IWM. IWM is way more liquid. Okay. It offers better options expirations. It offers tighter strikes. But the reality is this represents 2,000 stocks that most don't make money. Like right now, from what I saw late last year in Q4, 70% of Russell stocks, the Russell 2000, 70% of these stocks don't make money. That's not great. So as far as quality, I don't want that on my portfolio. I don't want companies that are struggling to make money. I get there's like optimism and enthusiasm, but it's like Russell doesn't really benefit until the Fed starts cutting rates. And right now, the Fed is higher for longer, pausing. If they cut rates once, does that really give the IWM a big boost? Probably not. So I'm going to stick with the kind of the cream of the crop, which is, the top 200 value, top 200 growth, and just kind of get that better echelon of quality out of the Russell. So I like the small cap trade. I think it has a chance to outperform large caps because it's been the total opposite. Large caps is beat up by a huge degree. But the concern would be that, people always think like, well, it means that small cap can outperform. Well, the reality is, what if they both go down, right? What if large caps go down, but small caps go down less? That usually doesn't happen. But in an environment where the Russell has already been beat up enough and it's been underperforming, look, large caps are up here, small caps are down here, one of the biggest segments ever of outperformance. If all this was this came down and this came down less, right? Then this means that it's actually outperforming even though both of them are down. So this whole idea of like, I've got to find the winner, I'm just trying not to get burned. If this market's going to do something stupid this year and nobody knows what or if, I mean, look, last year is a good example with how sensitive this market could be. 2 days, August 5th and December 18th, they were the largest volatility movements single day ever. And it happened twice last year. So this market is like, it is like a constant rubber band where when this thing like snaps and stretches and the elasticity, we can have like stupid stuff happen, right? And yes, the zero DT environment is like this potential like quant blow up factor that we could have moves get way worse than expected. But the ability to come swinging back with leveraged instruments and fighting back with zero DTE, it's like just the amount of capital getting thrown in day after day, like billions and billions of dollars of day trading options or zero DT options. It just means that volatility is a little bit higher and more sensitive, but it also creates like a clean slate every single day. And that's also why we haven't had like major, like look, 3% day was a huge day. Most of the time, the market's going to stay less than 1%. You're going to see a lot of moves. Intraday is going to be less than like a 1% move from start to finish. 1% up, 1% down, probably a lot less than that. And that's your basically 70 to 75% of the time. Market's only moving about 1%. Okay, or within 1%. So the outliers, it's just hard to get an outlier, But an outlier is going to be a big deal. Like I think we have another outlier on the VIX where we have another crazy move, and maybe it's as bad as it was last year, August 5th, which was over a weekend. And I get it was like a lot of sensitivity and vulnerability over futures on Sunday, and it gapped the markets down on Monday. December 18th was Fed Day. December 18th, Fed Day, low liquid or a little bit less liquidity, holiday trading. Everyone's kind of checking out, and then it was like a little slap in the face towards the end of the year. But the market by the end of the year came screaming back that by December 26th, we were right back where we started. So just a lot of chop there towards the end of the year. Anyway, all I'm saying is I look at this as an opportunity to, buy the dip until it ultimately fails. Right. And right now, the higher this goes, the more this stretches away, I'll smile if we're going higher. That's a little bit easier. My portfolio's tilted slightly bullish. That's fine. I still make some pretty steady income there. But as far as the timing, it would be getting ready or bracing for the opportunity of a drop or a correction. And I don't know what's going to cause it. That's the big thing I'm asking is what? Okay, what causes it and when and why and all the questions we have to ask. As far as risk management goes, these are the important things. And the answer is I don't know. I don't know what, I don't know when, I don't know how, I don't know who, but I have seen this market a lot, and I've been in these markets for a long time, and I don't love that I'm uncomfortable. Meaning, like the more this goes up, it's like that's cool. I'm gonna participate, but I'm just not as loaded and as bullish as we continue to have these like high bar count stretch away moves. And at some point, we're going to find it. And I think a good example to kind of prove that I'm not, sniffing glue here is Nvidia is exactly that trade. Okay. And Meta is exactly that trade. Okay. Look, Nvidia had a crazy high bar count going into this high from June of last year. Okay. Look at the bar count in Nvidia. Obviously, it's been one of the greatest stocks ever the last 20 years, and it just kept getting better and better. And everyone that's loaded up in Nvidia killed it. If you have any exposure in the Mag 7 or the S&P or the Nasdaq, you have Nvidia. Don't worry about it. So you don't have to feel like you're missing out. Look, the markets were up 20+% last year. Most of that was thanks to Nvidia, right? And then most of that was thanks to Mag 7. So you can still have exposure without actually having to take the volatility of an individual stock. Okay. But point is, look at the last time that we tested here. And by the time we hit the stretch away move, we had two things happening. This was a long ways away. We were 45% overextended from the 200 moving average. That's a big percentage away. Now, when we come back to here, when the market went sideways, that stretch away move was around 45%. So is it like unanimous across the board with like, well, S&P is always going to be this? No, it depends on the stock, and look back in time and scroll back in history and see if you have this crazy stretch away move and then it pulls back towards the 200 moving average, what's that percentage? And in this case, we had about a 40 to 45% percentage away from the 200 moving average. And what did price do? Well, it started to at least pause and go down a little bit and then had another push higher. Same thing here, another 40 to 45%. But we had a much bigger correction there, and we just missed it. But going into that bar count, this would have been from the time we tested the 200 moving average. We were 284 bars there. That's not like super high, but by this bar count, we're at 354 bars. Okay, and so I got a little bit more courageous when this thing dropped like it did July to August and then came back up to test the highs. I was really not bullish on Nvidia, because we, number one, didn't hit the 200 moving average, came back to the same highs again. You can see how choppy that 140 to 150 level was. And in fact, I ended up being correct, where I said we're probably going to hit the 200 moving average before we make any substantial higher highs. And we did. It obviously took some time. We had some chop here, but that bar count finally hit around 500 bars. Okay, now fast forward to Meta. Okay, fast forward to Meta. We finally had a nice little turn on Meta, but look at this bar count. This bar count since this last touch is 500 bars. And on top of that, this little move away from this 200 moving average, in my opinion, look at these historical context, we're 23 to 24% overextended. Go back to the last time we paused. This was an extended move of around 35%. So could Meta go higher? Sure. In theory, yes, it can go higher. We could stretch another maybe 10 to 15% higher. But based on a 500 plus bar count, I think we are closer to putting in a top than we are going higher. I think we're closer to putting in a top than going higher. Therefore, I'm taking a trade like this. That's a broke wing butterfly. If price stays below this, I make some money. I've got a profit trap just in case. These were taken at like a 9 delta, so I have about a 85 to 90% chance of profit on the trade. When I priced out this morning, it's got about a 94% chance of profit. I'd be happy with that, obviously. But all I'm looking for is, will this market start coming back into some reasonable levels? I don't mind buying the dip on Meta. I really don't. But I want to see this level get hit at least. And if we are selling off, I want to see the IV start to grow. I want to look to sell some premium. And I will try to stay out of the way, where I can put some positions in where maybe I can buy and consider owning some Meta at $400 instead of owning the thing at $700. So this is going to be an important chart to watch, which will also be this symbol, MAGS, which is basically your aggregate of MAG 7. If MAG 7 is not going to start going higher, I don't think these markets right now are going to be poised to go much higher. Just my take on the US markets right now. So if we stay here and stay sideways, okay, fine. Maybe it's a lot of chop that we're dealing with. But if MAG 7 breaks down, it's going to weigh on the markets because the market cap is so large. So your, SPY will drag down a lot, your QQQ will drag down a lot, your RSP might be a little bit better of a survivor, and your QQQE, those are equal weighted, right? So you don't have a large, 30% of the SPY is in MAG 7 stocks. It's more like, okay, now Microsoft represents 2%, or Apple or Nvidia represent like 1 to 2% of the equal weight, right? But this is going to be an important one to watch to see, are we going to get a lift from MAG 7? Are we going to get a sideways from MAG 7? It's like, I really think the market might be this easy. If the market is up with MAG 7, it's probably going higher. If we're sideways, expect more chop. If we're going down, MAG 7 is underperforming. And on top of underperforming, they're also spending a crap ton of money on AI. And right now, like, that might be this other thing that nobody's really thinking that the market's going to turn over on, but maybe they're spending so much so quickly that we come into our next round of earnings and people are going to be pissed about it. Investors are like, look, you idiots are spending so much money on AI that what do we get for return? Right? It's like, rather than being lots and lots of cash, lots of profit margins, like they're blowing it again, not blowing it, because it could be a great investment. Everyone says it's going to be the future of everything. So cool. But in the interim, do investors like it? So I don't know the what, I don't know the why, I don't know the how, I don't know the when, but I still know what I'm looking at. And so if I think that there is a reason to be cautiously bullish, that is exactly what I am. I mean, look, I'm happy we're making some highs. The market's leaking higher. I could see another 3, 4, 5% move, and this gets everybody excited. But man, I'm just holding my breath. Like this is it's like just a matter of time before we have something that causes a pullback. I don't know if we can go the entire year without pulling back to this 200 moving average. Because if we did that, let's say that we go all the way to December 31st. Okay, let's see how far out this can go. So I'm going to compress this chart even more. Let's go out here. How many more days would this be? So if I went to December all the way to the end of the year. Okay, so that would be around 218 bars. So we're already 320 some bars overextended. Okay. So if you tell me that we're going to be 540, 550 bars overextended, if I have room to trade back to that 200 moving average, I'm going to short the bejesus out of this thing going into 2026. I'll say that again. If we have not hit this 200 moving average by the end of the year and there is some space to trade, be in this. Let's say this market is just like the easiest bull market all over again, 3 years in a row, 20+% gains, and we're way up here. And meanwhile, this is just humming along, but way, way lower. If I can see this as a 10% opportunity or bigger, I'm going to take a pretty hefty position that would leverage and pay out like crazy. If I put like a 5% bear position on that could pay out somewhere between, 15 to 20% alone, I would take that trade into 2026. If I get proven right on that trade, I might be done trading for the year. Right? Like if I can capitalize on a bear market like that and a probability move, that might be the easiest way for me to trade in 2026 and then sit in cash, and just ride it out. Obviously, it's not going to happen. I don't sit in cash. I trade. I'll figure it out. But my point is, if I'm just sitting here waiting and waiting and waiting, and this market just keeps climbing and climbing the wall of worry, and I'm wrong, look, if we go 500 plus bars, I am shorting the market. If we go ballistic to the upside, and that stretch away gets into a percent that we haven't seen before, like maybe 15% higher or 20% higher, I'm probably going to look to time the market with a bit of a short as well. But I'm not there yet. Like I don't have that definitive technical proof that it's like it's time to short it. Instead, it's like, I guess we're going to keep going higher. So we go a little bit higher. Okay, we've made 3 all-time highs this year, maybe 4 all-time highs in the SPY. And can it keep building some momentum on that? Yeah, maybe. Maybe. All right, do I have anything on my radar for Forex? Not really. The dollar is something I'm watching. I'm long Japanese yen, but I'm not Japanese yen long with Forex. I'm long Japanese yen with FXY. I own shares of it. It's like trading the Japanese yen as well as Japanese yen futures out to September with options. So my Japanese yen exposure is not in Forex. I'm still in Swiss pairs with positive swap. So Aussie Swiss cat. It's like I've been holding those positions for over 2 years. Last year alone, it was like almost $30,000 in swap and profit. And I still made, I made like my dollar Swiss position paid out really, really well. I turned almost 30 positions in profit when the dollar Swiss hit 9,200. I was in that thing for 2 years and I got the profit that I wanted. I'm still holding the other ones long. I'm getting the positive swap. I'm liking all of them. Like Aussie Swiss is looking better. I want to see if we get above this 200 moving average and go up to my measured move around 6,000 or so. CAD Swiss, a little bit of drama with oil, but still looking really responsive off the lows at 62. I'd like to take this to 65 or ultimately take it up into, six. I mean, I'd love to say 7,000. This is ultimately where I'm positioning for the CAD Swiss, but I would be happy with, there's a lot of structure here as well. There's a lot of resistance and support here. So even a move into like 6,500, I'll take profit there. I'd love to see a trade ultimately that does something like this. If this is wave 1, 2, 3, 4, 5, around 6,700, take the profit on my CAD Swiss longs and then look to reestablish more positions. Okay, so this would be like trade 1. I'll box this in. If I box this in, trade 1, and then look for a trade 2 that I can stack in over here for another swing that gets me back up into this structure around 7,000. So CAD Swiss is still on my radar for like a big position trade opportunity. But right now I'm just waiting with some of the current positions I'm in. Okay, Euro Swiss. I'm leveled in here, looking to get back up towards 98.80. I think 1.00 is a fair target. I'll just keep an eye on that one. Pound Swiss, I'm still long. This one I'm trying to target recent highs at 16.50. I'd like to take this one all the way up towards 1.19. New Zealand Swiss, similar to Aussie Swiss, I'm just waiting. Measured move up here to 54. If we get a 3 wave out of this, if this is wave 1, 2, 3, 4, 5, coming back into this structure here, taking profit around like 5,600. So I'm willing to kind of sit and hold, get the positive swap. It's boring. Nobody's excited about it, but when it pays out, I mean, it's a lot of money. It's a lot of money in swap in a good way, and it's a lot of money in pips and price appreciation. It just takes a little bit longer than you probably want it to. So I'm not a short-term trader with some of these positions at all. In fact, I'm willing to wait another 6 to 12 months until I ultimately get what I want. Dollar Swiss, I'm already out of. So this trade's done. If we come back to like I'd say 85 or 8,400, I'm buying more dollar Swiss. I'm not selling this because I don't want to pay the negative swap. Yen crosses. The yen is, who knows, man. I mean, the yen is, nobody knows what the Bank of Japan is going to do other than them. I don't know if this is more like indecision on the pound yen or yens in general. Do we still have this like drama from July to August and we just deal with this range? Eventually, this is going to be a fall, or eventually we're going to have just a bigger test of this high. Do we test the high and test the low? Do we stay in the middle where it's like, I would just say this is an unfun environment. I don't want to trade yen crosses in this chop, So that's about it. Euro Aussie, Euro CAD, pound Aussie, pound CAD, Euro New Zealand, pound New Zealand. Haven't liked them in a while. I'm still long Aussie New Zealand to the upside. We did have a nice little push, which is good. So I'm sitting up around 130 pips on this one and trying to take this up a little bit higher towards like 1,400 or so. Take profit's going to be up here towards around 1,400. Okay, so there's my take profit there. That's about it. That is about it. So, all right. I know that we started late today, but I was in a webinar, so I appreciate everyone jumping in here, saying hi, saying happy Wednesday. Tomorrow we have no major news in the morning. We've got a big day on Friday with monthly expirations, PMI news coming out of the Eurozone and the U.S. I think there could be some volatility for the rest of the week. Where we are so far is we are carving out a green candle for the week. That's what the shaded background is. So let's see what it does. So we're higher again, like the 3rd or 4th all-time high in the SPY this year. Is the market super stoked about it? I don't know. If it holds green for the week, great. I think 615 gets hit. Question is, are we getting a little run to the upside and then a bigger snap back down based on that. Again, I say bar count, I say percentage away from the 200 moving average, and those are things that I'm pretty interested in. Okay. All right. Hope that helps. Thanks for being with me. I'll see you tomorrow. Thanks. Bye.